Happy Friday. More good news coming out in the last couple weeks. Specifically, good news to get us closer to a healthy housing market that we just have not had in a while. Right amount of balance and the right amount of supply. So, newly appointed director Bill Pulte, he's the newly appointed director of FHFA. He looks like he's going to be aggressively going after Fannie Mae and Freddie Mac. Fannie Mae and Freddie Mac have had $30 billion in earnings in the last few years, and he's targeting that. He's talking about giving them the Doge treatment, and it makes sense. If you think about it, lenders pay an exorbitant amount of money to Fannie Mae and Freddie Mac that most people don't even know about. So generally, we have 0.5% just in what's called guarantee fees, but then there's some additional things that we're charged for. They're called loan level pricing adjustments that vary based upon the loan, but that could easily add up to another 0.5% or more, depending upon the loan type. So think about that. Lenders are paying over 1% to Fannie Mae and Freddie Mac to securitize loans. Well, that, of course, gets passed along to the buyer. And high interest rates have been the Achilles heel of our housing market. They have hurt demand and they've hurt supply. So, speaking of demand, we have seen some improvements. So, we've seen an 11% increase in purchase applications. That is the best indicator of demand out there. And of course, that's directly correlated with the interest rates drop that we've seen. We've seen interest rates go from about 7.26 to about 6.7 as of today. National average, 20% down, good credit. So if we continue to come off the floor of what is basically a 25-year low for mortgage demand, right? We need that to continue to go up. And we also need more listings. Well, that's happening too. So if we look at national statistics for listings, of course, this is national, but most housing markets follow very, very similar trends. I've looked at the Front Range, I've looked at Steamboat, Western Slope, all following very similar trends here. We see that we have 28% more listings than we've had the last few years. We still have less listings, less inventory available than 2019 and 2020 at this same time of year, but if interest rates continue to fall, more people who have low interest rates on their existing home are willing to put those properties on the market and give up that lower interest rates. And so more listings are coming on. It's not been a giant jump yet, but hopefully interest rates keep coming down and more people putting their listings on. So you can see right here, we do have a little bit more listings coming on this year than we've seen the last few years. So more listings, more inventory, and more buyers are all going to keep us moving towards a healthier housing market, hopefully as soon as this spring and summer. If you have any questions about financing a home, give us a call. Let us know. Happy Friday.